Welcome back to the deep dive. We try to take these huge, sometimes pretty confusing topics and really break them down.
Get to the core of it.
Exactly. Today, we're focusing on something that gets a lot of headlines, the modern Japanese economy. We'll be looking at, where it stands now and some of the, frankly, complex challenges ahead. We've got some specialized source material to guide us.
And we're really diving into a paradox, isn't it? For years, Japan has pursued this incredibly aggressive monetary easing, basically flooding the system with cash, keeping interest rates at almost nothing.
Right. Zero interest policy, quantitative easing, the works.
The works. But the big question, the puzzle we're tackling, is why hasn't all that liquidity actually led to a strong, sustainable recovery, especially for the average person's wages and living standards?
And it's interesting. Our sources jump right into that skepticism. The author we're looking at, they generally support the new administration's economic plan, but they've got serious doubts about sticking with this low-interest easing policy.
Why is that specifically?
Because the weak yen that comes with it, which seems to be getting weaker, is apparently causing a lot of anxiety for households. Real worry.
And that highlights just how much the context has shifted. It's kind of bizarre, actually. When this really intense easing kicked off more than 10 years ago, the yen was strong, maybe around 80 yen to the US dollar.
Yeah, completely different world.
And that policy back then was designed to fight deflation, get things moving, but from a position of currency strength.
So compare that to now. We're looking at nearly 150 yen to the dollar? It's almost double.
It really makes you stop and think.
How can the exact same policy tool, used in such a fundamentally different economic reality, possibly give us the positive results people want now?
Well, spoiler alert, it probably can't. Not without some major adjustments elsewhere. Maybe we should quickly define the tool itself. Monetary easing.
Good idea. Lay it out.
So monetary easing is essentially the central bank trying to make money cheaper and more plentiful. They keep interest rates super low. The idea, the textbook goal, is simple. Get businesses borrowing, investing, get people spending, and ultimately, that should boost employment and wages.
That's the theory. Clean. Simple. But our sources are saying the outcome was completely different. The money got printed, sure, but it feels like it took a detour around the real economy.
It absolutely did. Instead of flowing into, say, companies buying new machines or households going out and spending, most of that cash ended up, in financial market.
Stocks. Real estate.
Precisely. Stocks, real estate. So you saw asset prices go up, which is great if you already own those assets, but for improving the average person's standard of living or boosting wages, very little impact. The money just got kind of stuck in that financial loop.
So it blows up that idea that you just print money and it magically appears in people's pockets. There's some kind of blockage.
Right.
Like the economy's plumbing is faulty.
That's a great way to put it. A structural failure in the plumbing. And our sources point to three specific structural changes that really took hold over the last, say, 30 years or so. These changes basically stopped the cash from getting where it needed to go.
Okay, let's break those down. What's the first one? You mentioned banks.
Yes, bank behavior. Because interest rates were kept so low for so long, banks found it easier and safer, frankly, to just buy low-risk government bonds.
Rather than lending to businesses.
Especially small and medium-sized enterprises, SMEs. Lending to them takes work. It involves risk. Buying bonds was easy. So even when the central bank bought bonds from the banks, injecting cash, the banks often just held on to it or bought more bonds rather than lending it out into the riskier business sector.
So the banks sort of opted out of their traditional lending role, starving the very businesses that tend to create most new jobs.
Yep.
Okay, that's a big one. What about the companies themselves? That's the second shift. Corporate behavior.
Right. Large corporations, maybe scarred by past downturns, became incredibly risk-averse. Their main focus shifted. Instead of investing in growth, expansion, new tech.
They focused on cutting costs.
Cutting costs and, crucially, suppressing wages. Holding wages down became a core strategy, and you can see this really clearly in two numbers the source highlights. First, corporate internal reserves. Basically, the cash companies are hoarding hit record levels.
Okay, so they're sitting on piles of cash.
Piles, and at the same time, the dividend payout ratio, that's the slice of profits they give back to shareholders, that also went up.
Wait a second, so profits are being made. But instead of investing that profit in the business, or importantly, in their employees through higher wages, they're choosing to hoard cash and give more to shareholders.
That's the story the numbers tell. It's just an active decision to prioritize owners and investors over reinvestment in productive capacity or people. That's a direct driver of wage stagnation, no matter how much money the central bank is trying to push into the system.
Wow, okay, so banks aren't lending effectively. Corporations are hoarding cash and prioritizing shareholders. What's the third piece? Household behavior.
Exactly. For wealthier households, any extra money often went into buying more assets, stocks, bonds, real estate, reinforcing that asset inflation that we talked about. But for lower and middle income groups, things were very different.
How so?
Real wages, adjusted for inflation, basically stagnated or even fell. Meanwhile, the cost of living, especially for essentials, kept climbing. This just widened the gap, creating huge economic polarization.
And there's a specific number in the source material that really drives home that household struggle, isn't there?
Yeah.
Engel's coefficient.
Yes, that's a striking one. The Engels coefficient, it measures how much of a household's total spending has to go just towards food.
A basic necessity.
The most basic. In 2024, it hit about 29%. Now, that's the highest it's been since 1980. After falling for decades, it started climbing sharply around 2015.
Nearly a third of your budget just for food. When you see a number like that jump, it's not abstract economics anymore, is it? It's about families genuinely struggling, having to choose between heating and eating. It feels like undeniable proof that living standards are falling for a lot of people.
It really underscores the hardship. So you put these three factors together: banks avoiding risk, companies hoarding cash and suppressing wages, and this growing divide in household fortunes, and you see that the whole mechanism, the plumbing for monetary policy, is fundamentally broken. Just pouring more water in at the top isn't working.
Which leads us directly to the elephant in the room right now, the weak yen. Because keeping those interest rates near zero while other countries are raising theirs, that has consequences, right?
Direct consequences. The persistent gap between Japan's low rates and higher rates elsewhere, particularly the U.S., drives down the yen's value. And a weaker yen immediately makes imported goods more expensive.
Especially critical imports. Food, energy.
Exactly, the things households cannot avoid buying. So it puts this huge direct burden on family finances, amplifying the struggles we just discussed with the Engels coefficient.
Now, you often hear the counter-argument, don't you? That a weak yen is actually good for Japan because it helps exporters sell more abroad.
You do hear that. But our source urges a reality check by looking at the actual composition of Japan's GDP, the gross domestic product.
Okay, so how does the economy actually break down according to the numbers provided?
While personal consumption spending by households is the giant chunk, it's about 53.5% of the entire economy,
And a half.
by far the biggest driver. Then you have private corporate investment, around 16.7%, and exports, the part that supposedly gets the big boost from a weak yen.
How much is that?
In the context of this specific calculation in the source, it's noted as being very small, around 0.5%.
Only 0.5%. That seems really low for a major economy known for exporting. But it makes the source's point crystal clear, doesn't it?
It does. It suggests that even if exports get a boost, their direct impact on the overall national economy is limited compared to domestic consumption. Policies focused only on helping exporters won't do much to lift the whole economy or ease the burden on the average consumer paying more for imports.
And these domestic issues aren't happening in a vacuum. Global factors play a huge role, especially what's happening in the U.S.
Absolutely. Think about the post-COVID period. The U.S. faced significant inflation, and the Federal Reserve reacted with aggressive interest rate hikes. Rates went from near zero up to 5.5% at the peak, and they're still relatively high, around 4% now.
And higher U.S. rates attract money,
Right.
pulling it away from places with lower rates, like Japan. Explain that flow for us.
Sure. Global investors are always looking for the best return for their money, adjusted for risk. When the U.S. offers, say, 4 or 5% interest on relatively safe government bonds, and Japan is offering close to zero, well, the choice is pretty clear for many.
So money flows out of yen assets.
And into dollar assets. Investors sell yen to buy dollars, which pushes the yen's value down even further. It compounds the weakness caused by Japan's own low-rate policy.
But it's not like the U.S. consumer's having an easy time either, despite those higher rates.
Not at all. There's significant strain there, too. Food and energy prices in the U.S. also rose sharply, often faster than wages. And what happens? People turn to debt. U.S. credit card debt is astronomical right now, nearly $1.2 trillion.
Wow, $1.2 trillion. That's staggering.
It's about 17% of the entire U.S. national budget. It shows that many American consumers are relying heavily on borrowing just to keep spending, which mirrors the kind of pressure we see globally.
And the source highlights a really stark contrast there, pointing to issues like the temporary suspension of the food stamp program, SNL, affecting potentially, what, 42 million low-income Americans?
While at the very same time,
U.S. stock markets, especially in things like AI and semiconductors, are hitting record highs. It just paints this picture of a widening wealth gap, not just in Japan, but globally.
it's a global phenomenon, absolutely. And here's another twist. Despite these signs of strain in the U.S. economy, the yen still keeps weakening, even against a U.S. dollar that's facing its own challenges.
What do you mean? The dollar is weakening too.
Relatively speaking, yes. The dollar index, which measures the dollar against a basket of other major currencies, actually fell quite a bit, 8.94% between January and October this year, according to the source.
So the dollar is down, but the yen is down even more.
Exactly. And you also see things like the rising price of gold. That often signals that global investors are getting nervous about the stability of major currencies, including the dollar, as the main way to settle international transactions. Yet the yen remains weak.
It really highlights Japan's vulnerability in this shaky global financial picture.
It absolutely does. Heightened vulnerability.
Okay, so if the problem isn't just the amount of money, but where it goes or doesn't go, then the solutions have to be different too. What does the source material suggest? How do we fix the plumbing?
The core argument is really about shifting focus. Stop just trying to increase the volume of money and start designing policies that specifically direct who gets the money, where it flows, and how it can be used. It's about targeted policies and regulatory changes.
Makes sense. Let's talk specifics. What about short-term fixes? Things that could make a difference within, say, the next year?
Okay, 3 main ideas here. First, direct help for those struggling most. That means immediate support for low-income households, maybe cash payments, maybe food assistance, something to cushion the blow from high import prices.
Right. Immediate relief. What else?
Second, targeted support for SMEs, the small and medium businesses. Not just general loans, but low-interest loans or credit guarantees that are conditional. The money must be used for specific investments like going digital, upgrading equipment, things that boost productivity, not just covering payroll.
So making sure the money actually builds something. And third,
some emergency measures for those critical imports, food and energy. This could mean temporary subsidies to bring down prices or maybe reviewing tariffs, things to ease that immediate cost pressure.
okay, that covers the immediate crisis for households and tries to kickstart some SME investment. But what about the bigger, deeper problems? The corporate cash hoarding, the wage suppression, those feel like cultural issues almost. How do you tackle those in the medium term, like 2 to 5 years out?
That's the tougher nut to crack, for sure. It requires nudging or maybe pushing companies to change their behavior. One idea is corporate investment incentives. Think about tax policies that actually make it less attractive for firms to just sit on huge piles of internal reserves.
Penalize hoarding, reward investment.
Essentially, yes. Create tax advantages for channeling that hoarded cash into research and development, into capital expenditure, into things that actually grow the business and potentially create jobs.
Okay, trying to unlock that hoarded cash. What about the workers? Wages?
That needs direct action, too. Labor market reform is critical. This means things like seriously looking at raising the minimum wage, supporting wage increases in specific sectors, and crucially, improving the pay and conditions for non-regular workers who often bear the brunt of cost-cutting.
Strengthening the position of labor.
And alongside that, financial system restructuring. We need to look at regional banks and other lenders to make sure they're actually channeling funds to local SMEs again, breaking that addiction to just buying government bonds we talked about earlier, revitalize local lending.
It really sounds like the source is saying that monetary policy alone is pushing on a string, unless you fix these underlying structural issues and maybe even tackle some deep-seated corporate habits, like prioritizing cost cuts over everything else.
That's exactly it. You can't expect monetary easing to work effectively if companies are culturally programmed to suppress wages and consumers are extremely sensitive to any price increase because their incomes aren't growing. Policy has to encourage or even force a change in those customs and behaviors.
So it's about creating a virtuous cycle. Short-term support to stop the bleeding, combined with medium-term incentives to fundamentally change how banks, companies, and households operate. Monetary easing might still be used, but it has to be secondary to these deeper reforms.
Precisely. The structural changes have to lead the way.
Okay, let's wrap this up. As we look ahead, sticking with this weak yen policy, or even seeing it weaken further, carries significant risks beyond just expensive groceries. What are the big things we need to watch out for?
Well, beyond the constant pressure on household budgets from energy and food costs, there are two other major risks highlighted. First is financial security, or maybe national security.
Oh, so.
If the yen is extremely weak, Japanese assets, stocks, real estate, even whole companies become very cheap for foreign buyers.
Huh.
There's a risk that foreign capital could come in and buy up significant chunks of the domestic economy. This could affect who controls major corporations and has implications for national economic security. It's something policymakers need to monitor closely.
Foreign takeovers, essentially. Okay, what's the second major risk?
This one's about people. It's the risk of brain drain.
Talented people leaving.
Yeah. If the gap in purchasing power becomes too large because of the weak yen, working abroad could become vastly more appealing, especially for young, skilled professionals. If salaries in Japan simply can't compete with what people can earn overseas in real terms, you could see an accelerated loss of talent.
Which would obviously hurt long-term growth potential.
No.
Okay, that's a lot to think about.
It's incredibly complex, yeah.
But the main takeaway seems pretty clear. Everyone might agree on the goal stimulating growth, but the old playbook of just relying on low interest rates and printing money seems broken. It won't work unless it's paired with these really specific, targeted reforms to change how the key players in the economy actually behave.
Exactly. And if the real solutions involve changing institutions, getting banks to lend differently, getting corporations to invest and raise wages, then the conversation has to move beyond just central bank policy. It becomes about political will and, frankly, demanding different behavior from those who control the capital.
A really crucial point to end on. Economics isn't just for the experts. It affects everyone, and these policy debates are something everyone should be engaged in.
Couldn't agree more.
Well, thank you for walking us through that complex picture, and thank you for joining us on this deep dive. We'll catch you next time.